Sydney, thank you so much, and thanks to Crowdbeat Media for putting this wonderful event together, and of course the National Press Club. You can't get more epic in DC than this. I'm Vince Molinari. Sorry. Not just you, Dara.
If it was Reagan, would say, "I pay for this microphone." Yeah, he
I'll just do this. How's that?
Yes,
Good. Perfect.
all right. So you paid for the microphone.
Thank you again. So I'm Vince Molinari. I'm the CEO of USA Capital. I guess the general disclaimer that we love to say, the views that I'm about to represent are mine only and not necessarily the organization of which I work for. So USA Capital is a registered broker-dealer as well as an alternative trading system, qualified matching service pursuant to a private letter ruling with the Department of Treasury, and most recently a approved quotation bureau for private unregistered securities, not yet launched. So wow, this is almost, Derek, going back to our, this is like not quite the 30-year reunion, but it feels like a little get together again with lots of the pioneers, and it's always very, very difficult going after Dara. I don't have any swag, but I'm going to leave that screen up there, self-promotion for a minute. But going back to even before the Jobs Act in the early days of the original titles, and speaking at Dara's events, and Sarah being here, and Dina Ellis, and lots of our great friends who've been around this process in different ways and shapes and forms. Some of us getting it right along the way, some of us getting it very wrong. Although, I guess I'm old enough, but I love this word to talk about pivoting, right? So we've pivoted along the way, and that disguises our failure or the new catchphrase. So there's been lots of learning curve, and I think what's awesome about these events, and my buddy Steve Sinelli is sitting here, and we've been through the trenches up and down, and figuring out how to get this marketplace right. And I think we're still very early innings. And the beautiful thing is, Dara's always full of education, and when we look at what's happening, the disruption, the awareness, our acceptance of communication on mobile devices. Maybe we were early 5 years ago, 6 years ago, maybe a little early 3 years ago, but I think, Steve, we arrived on time. So where's my great flicker? So I wanted to turn the conversation a little bit backward. Where's the exit, right? So I think as we have begun to see traction around what we say is the primary issuance, the aggregation of capital, and whether we want to talk about Reg CF, A+, any other methodology that's out there now, including one of my personal favorites, the ability to generally solicit, right? The connectivity of what we're beginning to see and the acceptance across in asset classes as well as investor stacks, retail to accredited to institutional. What do we always ask ourselves before the investment? What's my exit strategy? And I think that was if we go back in time and revisit history a little bit, 2009, 2010, we saw the demise of our public markets, at least from an IPO perspective and many other points. Sarbanes-Oxley, decimalization, order handling rules, Reg MS, whatever the culprit or the combination that we want to talk about, lack of IPOs, right? And we all know the statistics in the room, 500 IPOs down to 100, right? We've never seen that recovery. What most people were missing at that point, the evil empire of Wall Street is not making money on any IPO. But what we lost connection with is what it meant to be an investor, what it meant to enable and grow a company with the capital that we were putting in. So looking at the statistics, of course, the vast majority of our job creation in the country comes from our private sector. If we're not feeding our private sector and our emerging companies with new capital, they're not going to grow, not going to have job creation. Forget recovery, we're not going to have the expansion that we needed. So that was kind of our early looks of how do we facilitate that capital. We began to realize that we weren't going to fix the public market, so how do we create better access to capital without massive amounts of new regulation? Love the phrase, democratization of capital formation. And that really began lots of our early advocacy. In large parts, that became parts of the Jobs Act. So I think that was a very heavy lift that didn't need to be that heavy, but it became heavy through the rulemaking phase. And not for lack of, I would say, effort or trying by the Commission or FINRA or NASA for that matter. It was really cutting new territory, right? Thinking about the integration of social media into financial services, thinking about what the 34 and 33 Act was and the implication. So it was a harder lift. What we'd like to talk about now is really the connectivity and the symbiotic relationship between secondary liquidity and the front end of raising capital. We call that capital formation, the process of not just raising the capital, but education, awareness, and investor protection around the capital formation process. So we have a strong belief that if we could have secondary liquidity or access to secondary liquidity for private and emerging companies, it's going to be easier for them on the front end to raise capital. So as we're seeing more and more increase, and I really hate slides because then I have to try to follow something. As we see the increase and acceptance, and we all know the main components of the Jobs Act that we think are impacting this space. But the simplest thing, which was a great lift, 12D changes, going from 500 shareholders to 2,000, and within that body, exempting crowdfund record holders and employees. So you have a much, much longer runway of stakeholders to be built within a company. Ability to generally solicitate, or simply said, advertise for the first time in U.S. history, pursuant to the Jobs Act. Everything that Dara's talking about, the convergence now of social media and Wall Street, thinking about new distribution channels, the ability to create education and awareness through social media and have that tied to the ability to execute and purchase a security, massively disruptive and powerful engines, I think, that are beginning to get more and more traction. Reg A+, Reg CF, and again, you begin to think about the momentum and the things that are being posed today of increasing limits on Reg A+ now to 75 million, what could be 5 million on Reg CF, all pointing to a trajectory of higher issuances. And again, part of the process, as we think about certain companies, are beginning to realize if you have access to capital, you have secondary liquidity, and you have this elongated time frame, maybe I'm going to stay private longer. So what we're seeing now is private company valuations in the private sector, because alpha creation in the cycle is coming much earlier, right? Coming into the private sector. We never saw valuations of 10, 20, 30, 40 billion dollars as private companies. We're seeing that fairly regularly now. And granted, those are the unicorns. But that's creating great awareness, again, education, that investors are saying, I'll go earlier down in the cycle. The opportunity for valuation expansion is just not when the company goes public, and we begin to see that. It's much earlier in the cycle. So again, around methodologies in order to have that and the awareness, but secondary liquidity in that process. So if someone can buy a private security at a 500 million valuation or lower, and they have the ability to transact and realize profit in the process, pre-IPO, is much, much more stimulation in the process. And then you have the slew of companies who are saying, wait a second, I'm private. I don't have to comply with a lot of the regulation that we think is onerous and expensive as being a public company. Maybe we're just going to stay private permanently because we have the ability to transact, we have the ability to raise capital. So the paradigm, I think, is continuing to shift and will continue to do so. We can skip over lots of this stuff because most of it just speaks to data that we've all seen, and some of it is being updated as we speak. But no question, the increase in whether we're talking about Reg D offerings, certainly Reg A+, and I think, and Sarah from CrowdStrike will be the first one to tell you, Reg CF is going to get some legs somewhere, and there needs to be, in our opinion, a comprehensive venue, secondary platform to be able to transact and seek liquidity to continue to drive that capital formation, but perhaps most importantly, for investor protection. The lack of having liquidity or access to liquidity for private or unregistered securities, you start to see all the offline things that we don't want to happen. People who are transacting in these, maybe not even in a nefarious way, but they're conducting a securities business and then really not sure they are conducting a security business. They're collecting commissions. There's no visibility to the pricing of such securities in an individual capacity. No, I would say, order, if you would, of what we would think about as an order book, where bids and offers are currently. Dara was willing to sell it at 13. Somebody bought it at 17, but you only got 13. Somebody layered in 4 points in that deal. That's problematic for transparency. It's problematic for the health of the marketplace. So really what a lot of this has created is what we'll talk about as an inverted funnel. And if you go back to the early days, 2009, 2010, we saw a phenomenon that said the venture capital community was putting less money back to work because there was lack of exit. So we had decrease in IPOs. The size of the IPOs became dramatically larger, so limiting the exit strategies. M&A activity, yes, but no other exits. So what started to happen? An elongated hold period for our venture capital period, venture capitalists. So depending upon what statistics you look at, somewhere between 4.5 years on average, up to 10 years. So the internal rate of returns that those funds were now getting is compromised, but most importantly and most impactful, they weren't turning and redeploying that money as quickly. So we think there's a solution, and the solution is going back to the rule book, right? And we absolutely love the venture exchange concept. But we're, I think, living the experience of what has been the Jobs Act, and somewhere between legislative intent and what actually comes out in rulemaking at times, the time frame in which that takes, much longer than we thought. I had even a little bit more hair back when we started the process. But in the end of the day, that's out of everyone's control. So venture exchanges could be wonderful. We have the broker-dealer framework, but we think we need something in between that was more powerful and more robust. So we went back to the rule book. And we'll talk a little bit. Let me see what these got to say here. We'll come back to the quotation bureau in a second. This is what we believe the solution for secondary liquidity is, which is frankly an immediate solution. In 1998, the Securities and Exchange Commission had an issuing release called Reg ATS. Essentially what it said was all crossing networks, or ECNs, those of us who are a little bit older remember this, compelled them to either become a stock exchange or an ATS hosted by a broker-dealer. If you look into an ATS, largely all the same functions and abilities that a stock exchange can do, but you're not setting your own rules and you don't have your own SRO. Naturally, most of the ECNs, or in fact all of them at that time, elected to become an ATS. Little history, and this is where we think there could be some repeating of history as a solution. So Reg ATS at that time, 1998, compelled the ECNs, as I said, to become largely ATSs. And there was one line in the issuing release that said, our work on unregistered securities is not yet complete. Again, keeping in mind this is 1998. We went back to that, and in late 2015, we wrote a proposal to the SEC to amend Reg ATS for unregistered securities. I think it was met pretty favorably. Some folks said, well, we don't even have to amend this. It's really there. Well, lack of clarity, lack of market participants' understanding, but I think that helped set the stage for what became what we believe is one of the more robust ATSs that we've now been approved for, that allows us to transact in the full stack of unregistered securities, debt, equity, privates, restricted, converts, options, warrants, and effectively create a secondary marketplace. Alongside that, we have a recent approval for a quotation bureau, which we believe is the first of its kind, to be able to have independent mark-to-market quotes for private unregistered securities in real time with a 24/7 ability to take indications of interest. So when we look at that ability, and that's not just for us, there's plenty of other folks that can now go and do the same thing, but it begins to create a centralized location, a utility, if you would, for investors to seek liquidity, and for other investors who may want to buy into those opportunities or build a bigger position in a security that they may already own. So it's the age-old challenge and ability of any exchange is inventory and liquidity. So we're at the early stages of going to be launching that shortly. But I think the point in the history lesson is that when you look at the early eSands, and there was lots of them, from Javelin to Sonic to Tradebook, NextTrade, the two big bellwethers are very interesting. Both established in 1997, something called Archipelago, or Archer for all of us who might remember that one, and Island in 1997. And if you look at the trajectory, once we had the issuing release from the commission in 1998, within a few short years, 3 years, depending upon whose statistics you want to look at, they were both capturing very significant market share away from NASDAQ and the New York. As frankly, their lunch began to be eaten by a disruptive, innovative company, before it's fashionable to call them fintech, continue to eat more market share. You'll see down here, Instinet in 2002 bought Island. I think it was $500 or $600 million. A few short years later, you will see NASDAQ acquired the entire company for over $1.5 billion. The funny thing that most people don't realize today is NASDAQ today, in 2017, is still largely run on Instinet Island technology. So within 10 years, this little startup in fintech displaced and became effectively the NASDAQ technology. I think even more meaningful, if we look at Archipelago, again, most people don't remember the history, but going back, you'll see Arca merges with the Pacific Stock Exchange, if those remember that. That was a small public company. Arca became a public company. Within a few short years later, New York Stock Exchange merged into the Pacific Stock Exchange Arca public company. That's how the New York Stock Exchange became public. $6 billion valuation for that merge, plus or minus 10 years later from a startup fintech company. I think the most remarkable part of that story is that when you think what happened within a year and a half, 2 years, Arca's technology displaced the entire specialist floor of the New York Stock Exchange. And today, Arca is still the technology of the New York Stock Exchange. So I think, we'll go back to, I'm sorry, skipping ahead. So I think if we look at the power of disruptive technology and marrying it to regulation, and what I would say is current regulation that doesn't need amendments today, doesn't need legislative intervention, we have the roadmap to use the ATS technology to create an extraordinarily robust community that could be collaborative. And if we look at ATSs are mandated to connect to one another. What does that do? Creates more exposure and visibility for securities that are listed, greater liquidity, greater price discovery, and I think that in turn creates investor protection, layered on back to the beginning of the cycle, better likelihood and increased visibility for companies at the starting point to raise more capital or raise initial capital. And Sydney, I'm sorry, I'm not being mindful of the clock. Do I have another minute or two? Yeah, you do. Great. I'm sorry, fast. Just because I think it's so important, because it does give me a little bit of deja vu back to early days of crowdfunding and the Jobs Act, is blockchain technology. And lots of people frothing at the mouth about it, and I think it's absolutely, we should be frothing about it. But I think the important point to point out today, at least from our perspective, blockchain is absolutely amazing, but it's not doing anything differently for financial services than we're already doing today. We are still transacting, we're still clearing, we're still settling, we're still holding escrow, all of the things that we're doing. And yes, it does it much faster, more efficiently, it is immutable, but it is not doing any of the processes differently. So I think the takeaway that we just like to leave as part of stirring conversation or thought processes around blockchain, early days of crowdfunding, and Sarah and I particularly would joke about this quite a bit, it's not about the user interface for crowdfunding or the perception, this is, consumerization of the web for securities. There is the 33 and 34 Act and all these things to comply with. Guess what? You have the same thing for blockchain. So I think it's a bit of a misnomer when we talk about a decentralized ledger, when we move it to financial services, because the moment you have a securities transaction, you insert an SRO. It needs to be conducted through a broker-dealer or an ATS or through registered people. So I'll give the benefit of the doubt that it's somewhat decentralized and much more efficient, but it is back to basic, if I can use the adage, blocking and tackling, that this is a securities business being conducted on a new mode or a new technology. That's it. Does it need new regulation? Does it need a whole rewrite of history? Last point, Sydney, I'm sorry.
No, go ahead.
We did, to that end, write a proposal to the SEC for regulatory change to declare digital assets as securities. Again, if it walks like a duck and quacks like a duck, guess what? It's a duck. If there's rates of return, if you're aggregating individual money into an instrument, you may call it a token, you may call it a digital asset, but it behaves like a security, therefore it should be regulated by the Commission. Therefore, we have a waterfall of clarity that says needs to be transacted, guess what? Through a broker-dealer, through registered people. It may have an exemption, but you have to file for that exemption on how that security is being issued. And secondary trading, nice to have something called an ATS. So I'm sure I'm way over. I apologize, Sydney. On that note, thank you all very much. I appreciate it.